Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to explain to you the types of mutual funds. First, growth funds. The primary goal of a growth fund is capital appreciation, which means to earn the capital gains. They invest mainly in large, well-established companies with above-average growth potential. They offer little or no dividend, because the companies whose common stocks they buy reinvest their earnings rather than pay them out. Growth funds invest in stocks with greater than average risk, and they are suitable for aggressive investors. Next, aggressive growth funds. Next, aggressive growth funds. Aggressive growth fund is a highly speculative mutual fund that seeks large profits from capital gains. They invest in small, unseasoned companies with high price-earnings ratios. Unseasoned companies means those companies with short history of track record, such as a new startup company. They often invest in companies that are recovering from a period of very poor financial performance. Aggressive growth funds are among the most volatile of all mutual funds. These funds perform well when markets are good, and often experience substantial losses when markets are bad. Next, value funds. Value fund seeks stocks that are undervalued in the market. Basically, its focus is to look for stocks whose prices are trading below intrinsic value. As such, it requires extensive fundamental analysis on the company. That's why value investing is not easy. Value funds usually look for stocks with relatively low PE ratios, high dividend yields, and promising future. They look for undiscovered companies with potential for future growth. Generally, value funds are less risky investments for relatively conservative investors who are looking for moderate growth. Next, equity income funds. Equity income funds aim to purchase stocks with high dividend yields. The focus is on high current income with some long-term capital appreciation. They usually invest heavily in high-grade common stocks, some convertible securities, and preferred stocks. For the stock holdings, they mainly invest in blue chips, public utilities, and financial stocks. As the emphasis is on dividends and current income, these funds tend to hold higher quality securities that are subject to less price volatility than the overall market. In short, they are generally viewed as a fairly low-risk way of investing in stocks. Next, balanced funds. Balanced funds tend to hold a balanced portfolio of both stocks and bonds, for the purpose of generating a balanced return of both current income and long-term capital gains. They are much like equity income funds, but balanced funds usually put more into fixed income securities. The bonds are used principally to provide current income, which contribute to around 30 to 40% of the portfolio. Whilst stocks are selected mainly for their long-term growth potential, which make up around 60 to 70% of the portfolio. Balanced funds tend to be less risky than funds that invest exclusively in common stocks. Next, growth and income funds. Growth and income funds seek a balanced return made up of both current income and long-term capital gains, but with primary emphasis on capital gains. They invest in a blend of common stocks and fixed income securities, with up to 90% in common stocks. So the focus is on long-term capital appreciation, with some high income to provide limited stability. They tend to invest in quality issues, that is, growth-oriented blue chips, and high-quality income stocks. Growth and income funds are considered as moderate risk investments, meant for investors who can tolerate moderate price volatility. Next, bond funds. Bond funds invest in various types and grades of bonds, such as treasury bonds, agency bonds, municipal bonds, and corporate bonds. Income from the bonds' interest payments is the primary investment objective. There are some advantages to buying bond funds rather than investing directly in bonds. First, the bond funds are generally more liquid than direct investments in bonds. Second, they offer a cost-effective way of achieving a high degree of diversification in an expensive asset class. Third, bond funds will automatically reinvest interest and other income, so you may earn a fully compounded rates of return. Bond funds are generally considered to be a fairly conservative form of investment, but they are not without risk. The prices of the bonds held in the fund's portfolio fluctuate with changing interest rates. Next, money market funds. Money market funds invest in short-term money market instruments, such as bank certificates of deposit, treasury bills, etc. These funds offer investors access to the high-yielding money market. Maximum average maturity of their holdings does not exceed 90 days, so money market funds are highly liquid investment vehicles, as liquid as bank savings accounts. But their returns do move up and down with market interest rate. Money market funds are also nearly immune to capital loss, because at least 95% of the fund's assets are invested in top-rated or prime-grade securities. Many investors view these funds as a safe, convenient investment to accumulate capital and temporarily store idle funds. Next, index funds. An index fund buys and holds a portfolio of stocks or bonds, equivalent to those in a market index, like the S&P 500. Its objective is to match, not to beat the specific index. In other words, index funds simply try to match the market. They do this through low-cost investment management. In fact, the investment process is managed by a computerized system to match the entire portfolio with the targeted index. The investment strategy of index funds is buy and hold, which provides tax advantages with very little taxable capital gains. In addition, the operating costs of index funds are very low due to low turnover in investment portfolio. As index funds have very low realized capital gains, many high-income investors view them as a type of tax-sheltered investment. Next, sector funds. The investments of a sector fund are restricted to a particular sector or segment of the market. In other words, investments are concentrated in one specific industry sector. For example, healthcare sector fund, technology sector fund, financial service sector fund, real estate REIT sector fund, telecommunications sector fund. For a healthcare sector fund, it would focus on stocks issued by pharmaceuticals, medical suppliers, medical and healthcare equipment manufacturers, hospital management firms, and biotech firms. The main investment objective of a sector fund is to produce capital gains. Generally, a sector fund is similar to a growth fund, and it's considered speculative because it is not well diversified. Limited diversification can increase investment risks. Next, socially responsible funds. These are the funds that actively and directly incorporate ethics and morality into the investment decision. The idea is that social concerns should play an important role in investment decisions, just as financial matters do. Therefore, their investment decisions revolve around both morality and profitability. Mainly three aspects are considered: environmental, social, and governance aspects, in short, ESG. Socially responsible funds consider only specific stocks for inclusion in their portfolios. If a company does not meet the fund's moral, ethical, or environmental tests, fund managers will not buy the stock, no matter how good the company's financial performance is. Under these funds, some examples of excluded companies include tobacco or alcohol, gambling, weapons, fossil fuels, etc. These companies are perceived as not in compliance with the socially responsible criteria. The socially responsible funds tend to favor firms that produce responsible products or services that have strong employee relations and positive environmental records, and that are socially responsive to the communities in which they operate. Next, asset allocation funds. These funds spread investors' money across different types of asset classes, including stocks, bonds, and money market securities. Many of them also include foreign securities, and some even include inflation-resistant investments such as gold, real estate, and inflation-indexed bonds. An asset allocation fund provides built-in asset allocation by professional investment manager. Fund managers are hired not only to select individual securities, but also to allocate money among the various asset markets. It also provides convenience of one-stop shopping without having to own several mutual funds. Fund managers may design an allocation mix, such as 50% in stocks, 30% in bonds, 10% in foreign securities, and 10% in money market securities. As market conditions change over time, the asset allocation mix changes as well. Lastly, international funds. These are the funds that do all or most of their investing in foreign securities. Many people would like to invest in foreign securities, but they don't know how to invest. So international funds are for them. These funds can specialize in international stocks, bonds, or money market securities. They can specialize in growth, value, aggressive growth, and other types of stocks. Also, they can specialize in specific countries or regions of the world. International funds are considered as fairly high risk due to currency exchange risks. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.